Meet Chad. Chad's a 28-year-old software engineer who just YOLO'd his entire Roth IRA into NVIDIA calls because AI is the future, bro. His investment strategy? Buy anything with AI in the press release. His risk management? A Reddit thread with 47 upvotes. His girlfriend's concern? Why is he Googling how to explain a margin call to your fiance? Chad's not alone. Right now, millions of investors are convinced they're riding the next industrial revolution. Or they might be the financial equivalent of someone buying Pets.com stock in 1999 because people love dogs. Here's the thing about bubbles. Everyone's a genius until gravity remembers how to work. And right now, the AI market looks disturbingly similar to every major bubble in history. Same playbook, different special effects. So buckle up, because by the end of this video, you'll understand why the 4 most expensive words in investing are, this time it's different. Section 1. The concentration trap. Let's start with a fun fact that should terrify you. Right now, 7 companies, just 7, control 36% of your entire retirement account. Even if you think you're diversified, the Magnificent 7, Microsoft, Apple, Google, Amazon, Meta, Tesla, and NVIDIA. If you own an S&P 500 index fund, more than 1/3 of your money is riding on these companies. That's not diversification. That's a concentrated bet wearing a diversification costume. And we've seen this movie before. In the early 1970s, the Nifty 50 made up 45% of the entire market. Companies like Coca-Cola, McDonald's, and Polaroid. Wall Street called them one-decision stocks. You only needed to decide to buy them. When the bubble burst in 1973 to 74, Polaroid fell 91%, McDonald's dropped 70%, and the market didn't recover for 8 years. Every time this happens, investors say the same thing, but these companies are different. They never are. Section 2. Priced for fantasy. Now let's talk about what you're actually paying for these companies. The average S&P 500 stock trades at 15 times earnings. That's normal. Here's what you're paying for the Magnificent 7. Google and Meta, 28 times earnings. Amazon, 35 times. Apple, 37 times. Microsoft, 38 times. NVIDIA, 50 times. Tesla is trading at 247 times earnings. That means at current profit levels, it would take 247 years to earn back what you're paying today. For context, 247 years ago, the United States didn't exist yet. These valuations assume everything goes perfectly. No competition, no regulation, no economic downturn, no Elon tweet disasters. They're priced for perfection in an imperfect world. And when you pay 50 times or 247 times earnings, there's no room for error. One missed quarter, and gravity comes back with a vengeance. Section 3. The 330 billion gamble. But here's what makes this bubble different, and more dangerous. This year alone, the Magnificent 7 are spending a combined $330 billion on AI infrastructure. That's more than the entire GDP of Finland. And here's the kicker. This spending is keeping the US economy afloat right now. But spending money doesn't create value. It only creates value if you get a return. And that's where the cracks show. A US Census Bureau survey of 1.2 million firms found AI adoption among large companies is declining, not increasing. A McKinsey report found 8 out of 10 companies see no significant bottom-line impact from AI. An MIT study found only 5% of AI pilot programs deliver measurable returns. That means 95% don't. We're 3 years into the AI boom, and we're still waiting for the killer use case that justifies $330 billion per year. ChatGPT is impressive, but is it $330 billion per year impressive? Wall Street isn't asking that question yet, but they will. Section 4. The circular money trick. Now here's where things get sketchy. There's a circular flow of money between these AI companies that's artificially inflating everyone's revenue. Here's how it works. Microsoft invests $13 billion into OpenAI. OpenAI uses that money to buy cloud computing from Microsoft Azure. Microsoft uses that revenue to buy chips from NVIDIA. NVIDIA invests back into OpenAI. Each company records these as revenue, boosting stock prices, even though it's the same money doing laps. It's like if I paid you $1,000 to paint my house, you paid me $1,000 to fix your car, and we both claimed we had thriving $1,000 businesses. Technically true, practically meaningless. NVIDIA's stock is up 1,600% since ChatGPT launched. But here's the thing. NVIDIA sells the shovels. OpenAI digs the quarry, and nobody's found gold yet. OpenAI needs to hit $200 billion in annual revenue by 2030 just to break even. Right now, they're at $10 billion. That's a 20 times increase in 5 years. It took Google 20 years to build a $200 billion business. OpenAI thinks they can do it in 5, starting from a product that loses money on every user? The math doesn't math. Section 5. The scaling wall. And then there's the technical problem nobody wants to talk about. AI progress is slowing down. When ChatGPT 3.5 launched, it was revolutionary. Then GPT-4 came out, massive improvement. Everyone believed we were on an exponential curve, but then GPT-4 Turbo, incremental, GPT-4o, slightly better, GPT-5, and the jump is nowhere near what we saw before. This is called plateauing scaling laws. For years, the belief was, throw more compute at AI and it gets smarter. More GPUs equals better models. But we're hitting a wall. 1. We're running out of data. By 2027, AI will have consumed nearly all human-generated content on the internet. 2. More compute isn't producing the same improvements. This is a massive problem, because the entire AI investment thesis assumes progress will keep accelerating. If progress plateaus, why spend $330 billion per year? That's the question that will pop this bubble. Section 6. Who's most at risk? Not all of the Magnificent Seven are equally screwed. The key question: do they have a plan B? The safe ones. Google, Amazon, and Meta can repurpose their AI investments for existing profitable businesses. Google uses GPUs for search and ads, $200 billion per year. Amazon uses them for e-commerce and AWS, already profitable. Meta uses them for content feeds, $174 billion in ad revenue. They have safety nets, maybe 20 to 30% corrections, but they'll survive. The risky ones. Microsoft is all in on AI with no plan B. They've spent $80 billion betting enterprises will adopt Copilot and Azure AI services, but enterprise adoption is going the wrong direction. Companies are still in pilot phases, building and testing, not buying and deploying. If adoption doesn't accelerate, Microsoft could see a 40 to 50% correction. NVIDIA is the paradox. They sell the shovels, so they're safe, right? Wrong. Their entire valuation assumes AI spending grows forever. If hyperscalers cut spending, NVIDIA's revenue collapses. Remember Cisco in 2000? They sold routers to telecom companies. Everyone needed their products. Then telecoms stopped buying. Cisco fell 86%. NVIDIA is one spending cut away from the same fate. Potential 60 to 70% correction. Tesla, at 247 times earnings, is betting on full self-driving. They've been promising it for 10 years. Meanwhile, Waymo already has autonomous taxis operating. If FSD doesn't materialize, Tesla could see a 70 to 80% correction. Section 7. The Depreciation Time Bomb. Here's the final piece nobody's watching. Depreciation. All those billions in data centers and GPUs, they depreciate over 5 to 10 years. For the first few years, income statements look great because you're only showing a fraction of the cost. But eventually, those costs catch up. If enterprise adoption doesn't accelerate, there will be an inflection point where depreciation becomes too much to justify, and companies will cut spending. When that happens, NVIDIA's revenue drops. Oracle's growth stalls. The circular financing system unwinds. This time bomb explodes in the next 12 to 24 months. So here we are. 7 companies control 36% of the market. They're trading at valuations that assume perfection. They're spending $330 billion per year. They're passing money in circles. Enterprise adoption is declining. AI progress is plateauing. And a depreciation bomb is ticking. Every warning sign from past bubbles is flashing red. But here's the thing. This bubble can last longer than you think. As long as companies keep reporting revenue growth, even if it's circular, and investors keep believing, the bubble keeps inflating. The 1970s bubble lasted years. The dot-com bubble lasted years. The housing bubble lasted years. Bubbles don't pop because of fundamentals, they pop because of sentiment. And right now, sentiment is still bullish. But Warren Buffett said it best. What we learn from history is that people don't learn from history. So here we are once again, whispering the 4 most expensive words in investing. This time it's different. Spoiler alert, it's not. So what do? 3 things. 1. Reduce concentration risk. Rebalance into equal weight funds or add international exposure. 2. Favor companies with plan Bs. Google over Microsoft. Amazon over NVIDIA. Meta over Tesla. 3. Build a cash position. 10 to 20% cash gives you dry powder when the dip comes. Buffett's sitting on $325 billion in cash. That should tell you something. The question isn't if this bubble will burst, it's when. And when it does, will you be ready? Or will you be like Chad, Googling how to explain a margin call to your fiancé? Drop a comment. Do you think the AI bubble is real? Or am I just yelling at clouds? And are you reducing your AI exposure or riding this wave? I read every comment.